Not-for-profit organizations, lessons learned from implementation of the new financial reporting standard was a live webinar that was originally produced on Thursday, July 25th, 2019. For this webinar, we were joined by Janice Snyder, Gary Dubas, and Jim Shellenberger with McKonly and Asbury. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Good afternoon, everyone. Thank you for joining us. Welcome to our webinar on non-for-profit organizations, lessons learned from implementation of the new financial reporting standard. So if you're one of those organizations that already adopted, as many have for 12/31/2018, you've already been through this, but the vast majority of nonprofits will be working on this for their 6/30 year ends. I am Janice Snyder, listed there as a brief bio. I'm a partner with McKonly and Asbury. I specialize in working with healthcare, nonprofit organizations, and some food manufacturers and distributors. And my personal fun fact is experience the magic. Jim or Gary, you know what that's referring to?
Would that be Walt Disney?
It absolutely would. I love Disney. Kids are just at that age and very excited to be planning my next trip. So I'll turn it over to Gary.
Hey everybody, how you doing today? This is Gary Dubas. I'm also a partner with McKonly and Asbury. I head up our nonprofit industry segment for the firm. I was just doing an update of my profile for a proposal here today, and I have over 30 years of experience in working with nonprofit organizations. So I've been doing it for a while. Also do some things with affordable housing and also oversee our IRS Form 990 preparation process. Fun fact, I enjoy playing golf, par for the course, and kind of regarding when it comes to playing a course and you play it several times, you get better at it. And I think we have become better at implementation of the new nonprofit standards as we have gone through it with our clients several times. Jim.
Good afternoon. This is Jim Shellenberger. I am not a partner with McKonly and Asbury, as Gary and Janice made sure to emphasize that. I'm a principal and a member of the not-for-profit leadership team. Not quite 30 years of experience, but I won't tell you exactly how many years, but it's getting close to that. So I work with our not-for-profit organizations, some affordable housing clients, and really oversee our firm's uniform guidance practice, and that is the audit of federal compliance. My fun fact is to dare is to do. Gary and Janice, I'll ask you if you know what this means.
Soccer, maybe?
It is. This is the motto of my favorite soccer team, the Tottenham Hotspur, located in North London, the best team in North London, if any Arsenal fans are on the call. But as I think about the nonprofit standards, to dare is to do is not to be afraid to take a challenge, to go forward and try something that's new and different. And these standards are new and different, and we've been through that challenge and excited to be here to share some of those lessons learned with you today. Janice and I are looking at each other like, whose slide is this? This is my slide, Janice. So just a disclaimer that the opinions that we're sharing today are those of our own. We are not the FASB. We do not attempt to be the FASB or any other regulatory body. So that disclaimer is out there.
Thanks, Jim. So our agenda for today, as we said, is we're going to briefly overview some of the changes, and we're going to go through the 5 major changes and then give you the lessons learned related to each one of them and some of the best practices and some discussions that we've seen so far. And we've already received some questions from our audience and those of you participating today, and we look forward to answering those questions, but hopefully there's a few more out there so we can have a good dialogue this afternoon. So our objective is to further understand these standards and their implementation challenges. So we do have 3 polling questions today. I get to lead you in the first one, so please take a moment and answer this. This is how you get your CPE today. So why are you participating in this webinar? So just take a second and submit that so we can see. We always get those few individuals that are just seeking CPE, and in a reporting year, that certainly happens.
Janice, you're not aware of it, but that's why Gary and I are here too.
Oh,
That's
okay,
right.
good to know.
We're here to get our CPE as well.
So hopefully most of you either work for a nonprofit organization or you're on a board and want to understand these better, so you can submit some good questions.
You can see just about everyone's responded. We're at 90% response rate so far, now 92%. So get those answers in for us.
Excellent. So the majority of our audience, 52% of you, do work for a nonprofit organization, and you want to see the impact that this standard will have on your organization. And then almost 20% are on a board, and then 30% of you are participating for CPE. So, and that's okay too.
That's all
Hopefully
right.
you'll be slightly entertained and learn something today. All right, I'm going to turn it over to Jim to start the overview of the standard.
All right, so just as a reminder, Janice mentioned it earlier at the beginning, these standards and changes are effective now. So ASU 2016-14 was released back in 16, and it is effective now. I put the year-end dates on there for you as well. These are often referred to as the most significant changes within the not-for-profit reporting industry in the last 2 decades. I think that is true, and we'll talk through some of those changes here in just a minute. So the 5 major changes as a result of the standard are here on this slide. So we have net asset classification, investment return, expenses, statement of cash flow, and liquidity and availability of resources. A lot of those terms and concepts are the same, with the exception of liquidity and availability of resources that have been in practice for a number of years. We're going to walk through each one of these very briefly and talk about lessons learned. So I'll be taking the first couple ones and talking through that with you. As Janice mentioned, I'm going to say this a couple times. Please send in questions throughout the process. We have the ability and the desire to answer these questions throughout the process. We want to make this as interactive as possible. So we will move forward with the first section, which is the statement of cash flows. So the statement of cash flow, the changes that were occurring because of this relate to the option of not-for-profit organizations to choose the free choice between the direct or indirect method of reporting operating cash flows. For those of us in practice who are preparing cash flow statements pretty frequently, our natural desire is to present the indirect method, often known as the reconciliation method. It's the easiest method to prepare. It's what we learned in school, and it's more closely related to the rest of the other statements, is being able to tie back and forth. The standard presents that option to nonprofit organizations to choose between them, right? If you do choose the direct method, you are no longer required to also present the indirect method. So our lesson learned from this, don't do it unless you have to. It's not required, and it often will take more time and effort in order to implement. The user will typically prefer the direct method. So those people who are reading the financial statements, whether that's a funding agency or the general public, the direct method is often easier to understand. However, I want those on the call today to understand you need to weigh the cost benefit of implementing that. Just because of somebody's desire doesn't always mean you need to do it. Gary and Janice, have you seen any clients that you've worked with, organizations you're involved with, elect to do this?
So, Jim, I have not. I know that some of them have to and are required to by other regulations and things they need to do, but I have not seen any client that has chosen to present this voluntarily. I do know when the FASB wrote the standard and a lot of the discussions in the Q&A that they had, they believed that a lot of organizations would switch to the direct method as they believed their users would find it more beneficial. And while they may, as you weigh the cost benefit, I haven't seen any organization want to do this.
Right, and that's been consistent with what I've seen as well. You know, direct method is just a little more cumbersome to do. Now, once you get it set up after the first year, it certainly becomes much easier. But overall, the nonprofits that we've been working with have not seen a strong desire to go ahead and switch to the direct method.
And Janice did make a good point I want to reiterate. If you were previously required to do so from a regulatory standpoint, you can't opt out of that and cite this standard as that reason. I've had that question asked of me. So if your funder or your grantor is requiring that, you need to follow along with those guidelines. Okay, we'll move on to the second of the 5 categories, and that's investment return. So the changes in this area surround reporting of investment income and investment return on the statement of activities. This standard is requiring a net basis presentation. So that is your unrealized and realized gains and losses presented with all external and direct internal expenses shown on one line. So in the past, a lot of organizations would have 3, 4, sometimes 5 different lines all related to investment income. The standard is requiring all of that to be put onto one line as a net basis. It further eliminates the current and previous requirement to disclose those components separately. A lot of footnote disclosures would have a breakdown of that investment income into those categories. That's no longer required. The reason for the change, the FASB thought that this would be the most comparable measure of investment return from one organization to the next. The FASB is concerned about making not-for-profit organizations' financial statements easy to understand and easy to read from one organization to the other, and this is one of those key areas they focused in on. So I'll briefly touch on those internal expenses. I've gotten this question a lot from organizations that I've worked with. What are direct internal expenses? It is defined as those expenses that include direct conduct or direct supervision. This is important here, the strategic and tactical activities involved in generating investment return. When I read that, my natural reaction is it's going to be very difficult to be able to prove that unless you have a very sophisticated time entry system and you have somebody within your organization's staff who is dedicated to that task. It excludes things such as not associated with generating investment returns, such as general administrative management of the investment portfolio, dealing with contracts or pooled fund administration. So I have gotten that question a couple times. Okay, go to the next slide. So lessons learned. If there are any direct expenses, you want to identify those early. I'm sorry, Tyler was giving me a hand signal here. I think I'm turning my head too much from the mic, so I apologize that. So if you have any direct internal expenses, you want to identify those early. It makes the reporting a little bit easier. And if you do have direct internal expenses, are they really material enough to warrant the administrative burden to accumulate and make that change? You're going to hear us talk a lot today about materiality and whether or not something is of significance enough to impact the financial statements. Materiality certainly comes into play, and this is one area where it does.
Sure. I know I've seen this, Jim, and had dialogue with some clients when they say, okay, we're fortunate enough to have some investments, and we have a committee, and it's a board committee that helps oversee and direct them, but our CFO sits on that committee, and they're probably spending, in addition to reviewing reconciliations, maybe 10 hours a year on that committee and other things. And certainly to most organizations that would not be material to start allocating their salary for that small amount. Now, if it's half of their job, it certainly would be worth considering, and you would have to evaluate that relative to your financial statements as a whole.
Great, thanks. I did have, before I move on to the next topic and out of investment return, I did have one question come up regarding the statement of cash flows and what does a direct method look like. A direct method cash flow statement for the operating section would report things such as cash received from contributions and cash paid for expenses, where the indirect method is a reconciliation of the accrual accounts on the statement of financial position. So the change in accounts payable, the change in your accounts receivable.
Sure, you would see more of those cash inflows and cash outflows, and you would see them by category, like salaries paid, rent paid, utilities paid, those sorts of things would show up on a direct method cash flow.
Great. So again, thank you for that question, and keep the questions coming throughout the presentation. So I'm going to move forward here into net asset classification. Net assets, the standard 2016-14 took the three previous categories of net assets, unrestricted, temporarily restricted, and permanently restricted, and replaced them with only 2 categories. There's a lot of confusion in practice whether something fell into the category of temporarily restricted or permanently restricted. The FASB said enough confusion. Does it have donor restrictions or does it not have donor restrictions? So very simply, 3 categories changed into the 2 that are presented. Now you'll see when I get to the next slide and some of the examples, some of the disclosure requirements have changed. Within your with donor restriction category, the concept of permanently restricted still is there, still being maintained. The term has been replaced, though, so no longer calling things permanently restricted. It's now funds of perpetual duration. So the concepts have not changed. The categorization and the captioning of those within the statements is what has changed here. So here's an example, very briefly, of what that looks like on the statement of financial position. You can see two categories at the bottom of the page in the red box, with donor restrictions and without donor restrictions. This is one of the options for presentation format. It's not a required format. This detail is required to be included within the financial statements themselves, but not necessarily on the statement of financial position. Gary and Janice, in your observations, are you seeing organizations take this approach or more of a footnote disclosure approach?
I would say that this approach is what I'm seeing, but it's probably just barely leaning that way, as opposed to disclosures and then notes. So there certainly is flexibility there, and if you've got a number of designations, then it ends up making the statement a little too wordy, and so then you look at more of a disclosure in the notes.
Sure. Gary, I would say I've seen quite a mix, and I would say a smaller nonprofit, probably net assets of $5 million or less, are more likely to put it right on the face because they're only going to have 2 or 3 lines of each category. But as that gets much longer and they have many more lines of without donor restriction or with donor restrictions, they're tending to move that to a footnote, and then the face of the statement of financial position can be very clean with just the line net assets without donor restrictions and net assets with donor restrictions.
Yeah, I'm seeing most organizations like that clean approach and not trying to make the statement of financial position too lengthy and too crowded, if you will. Great. So an example of the next statement, the statement of activities, a lot of organizations will use the column format here that I've demonstrated, again, replacing that permanently restricted column with just a column for with donor restrictions, so from 3 columns to 2. The FASB has continued to allow this method of presentation, which I think is my preferred method, but they also offer what they call the pancake method, which stacks the 2 columns on top of each other. I personally think that starts to get a little crowded and more difficult to see and to read from a board perspective or somebody who's reading the financial statements, but both are acceptable formats.
I can tell you, Jim, that nonprofit healthcare organizations must use what they call the pancake method and must present their items without donor restrictions first, and then the items with donor restrictions in a linear format underneath that. So the way the information flows is the same, but again, only 2 categories.
So there were a couple of additional changes in this area as well. So net asset classification, enhanced disclosure requirements. So any disclosures on those net assets need to be further described, both from a quantitative and qualitative perspective, particularly around board-imposed limits, often called board-designated net assets. The composition of net assets with donor restrictions also needs to emphasize, and we'll get into this a little bit with the liquidity disclosures, whether there's any impact to the organization's financial assets and their ability to use their availability of resources. Won't get into a lot of detail around underwater endowment funds. We have not seen a lot of this currently, but I would expect some over the summer to come in. But there are also some enhanced disclosure requirements for underwater endowment funds. I had a question come in before I get to a couple lessons learned about whether or not a nonprofit has to restate prior year net assets to reflect the new presentation for reporting years. The answer to that question is yes. The organizations has a couple options regarding implementation in the first year and not applying things to the prior year, particularly functional expense allocation and liquidity of disclosure, which Gary and Janice will talk about here in just a couple minutes. Net assets do need to be presented in those 2 categories of with and without donor restrictions for all years presented in the financial statements. That's a great question.
That is, Jim, if the organization is continuing to present comparative financial statements. I work with some nonprofits that have chosen to go single year, so they don't have to go back and adjust the prior year information. So as long as the agencies you're working with and the regulatory bodies that utilize your financial statements will permit that, you can move to single year presentation for the year of adoption.
Yes, Janice, that's absolutely true. And I think it is a opportunity, and we'll talk about this, for streamlining financial statements. And one of those options is going to that single year presentation to make that implementation just a little bit easier. So a few lessons learned. Determine that level of disaggregation very early in the process. It shouldn't be a decision that's waited to the end, right before you need your statements to be finalized and issued. It's just going to help the process, because this change, while not significant in the technical aspect of it necessarily, it does administratively change your statements in a lot of different places. We've seen issues where boards might not have the appropriate policies in place for managing designated net assets, underwater endowment funds, etc. As Janice mentioned just a minute ago, the 2-year comparison for disclosures, I guess she's smiling in the room here. She knew the point was coming. The 2-year comparison is required and can take some additional effort for having to go back to a prior year. Some organizations are really going towards that method, if they're able to, of a single year presentation. And finally, I get a question a lot during organizations I work with: should we maintain the detail within the general ledger system itself, the accounting software, or offline? You want to make sure that that decision is vetted early again in the process, and that everybody is buying into that. It's one thing for changes to be made to a GL system or accounting software package, but not done completely, and then that offline information is not maintained or updated appropriately. Okay. So we're here for polling question number 2 now. Which of the following is not one of the 5 major changes caused by this standard? So you have net asset classification, liquidity and availability of resources, leases, and functional expenses. All right, so we're going to keep this open. Remember, this is for CPE purposes. We are not tracking your correct or incorrect responses, and you're not going to get a scorecard about this. But it is important for those who are here for CPE to show their participation.
I think we're going to follow up, though, individually with people if they get all the answers incorrect. So,
yeah. Especially for those McKonly and Asbury employees who have tuned in this afternoon.
That's right.
Mostly named Eric Blocker. Okay, 5 seconds left. Get those answers in. I can see 91% of you have answered, and we're going to show you the results right now. So thankfully, 71% of you got the answer correct. Leases is not part of this standard. The other 3 categories are. Leases is its own animal, which we will be talking about in future webcasts and webinars at great length. So I'm going to turn this over now to Janice, who's going to talk through liquidity and availability of resources.
Great, thanks, Jim. So if you can tell, Jim had 3 of the quicker ones, and we're building here in terms of length and complexity that it may take the organization to implement the aspects of the new financial reporting standards. So liquidity and availability of resources. This is certainly an interesting one. As we know, public companies and their 10Ks and their 10Qs have to look forward and provide a lot of forward-looking information and a lot of comparative information. And up until this standard, private companies and nonprofits did not have to do anything of that nature. So when the standard setters got together, they said, why not have nonprofits lead the charge and be the first ones to figure this out and to refine these disclosures? So certainly that was an interesting choice. But this does require you to provide quantitative information about the availability of your financial assets, looking forward for 1 year from the date of the statement of financial position. So you have to look at your balance sheet and say, what are financial assets? So your cash, your investments, your receivables. Sometimes you have cash surrender value of life insurance, things that you could tap into if you needed them to fund future operations for the next year. Then you also have to back out if there are any types of restrictions or anything like that. You have a couple of different choices on how you present that, but you also have to provide qualitative information. So generally a paragraph describing how you will fund the next year of operations. Could you access lines of credit if needed? Do you have other operating reserves? Could the board release some designated net assets if necessary? And kind of how you try to manage your cash flow. So how much cash would you like to have on hand? Those sorts of things are what now need to be disclosed in a footnote to your financial statements. So here is one example. There are 3 different examples in the standard where you can look at financial assets, and this is a very simple one. This entity does not have investments or anything of that nature. So they just have cash and accounts receivable. And we put a note there off to the right that the cash on the face of the balance sheet was $1.4 million, and they had backed out $49,000 of funds restricted in perpetuity. So get used to that term, in perpetuity, because that would be the old permanently restricted. What I've seen more organizations say, my cash is $1.4 million, my accounts receivable are $420,000, and then they would back out the $49,000 so that every number ties directly to the face of the statement of financial position or the balance sheet. It's really a choice of the organization and how they want to present this. I've also seen organizations, I was just reviewing one this morning, where they put everything into a paragraph and they said, we have this much cash and this much receivables, and they list it all out. It's a little bit more cumbersome. I think most organizations are choosing a table with a description. And then you can see here, this is a very simple one, but they're talking about their lines of credit that they could tap into should they need to, and then referencing the footnote where they disclose that. So certainly something new, something to think about as you want to tell the story of your organization and how you are going to fund your operations for the next year. It's now required, and there's a lot of flexibility in that. So what are some of the lessons learned? The lack of policies around cash management. So how much cash does the board want to have on hand? How much operations do they want to be able to fund with what they could tap within the next 12 months? Is that 60 days, 90 days, 180 days? Those sorts of things. Organizational leadership, have they approved the information that they want included in the disclosure? So what are you going to disclose and why are you going to disclose that? I think the trickier part of this piece is if there are limited financial assets. So maybe you have $20 million worth of investments. That's a very fortunate nonprofit organization, but they're all restricted for your endowment and you can never use the principal. So then you say, oh, we have a policy that we can use 4% of that in the following year to fund operations. So now you have an additional amount on your financial statements in this table, or that you would at least want to disclose that you can use that to fund the next year's operations. Some organizations forget that the board designated something or they set it aside for a capital project. I know going through an audit last year, I had an organization whose unrestricted net assets had a piece that was the true unrestricted, and then they had a board designated component, and the board had actually designated more than what was left in their unrestricted net assets. So it was actually a negative number. And I said, you really want to make sure you're in front of that next year, because this footnote disclosure, that's not going to look very good. It's going to look like you can't fund the next years of operation as an organization because of that negative undesignated net assets, or without donor restrictions, as we would call them now.
A number of organizations also have an unused line of credit, and that often is something that we suggest to put into the disclosure, that you would have the ability to draw on that for operations over the next year as well. So it shows a little bit more of liquidity availability if needed, even though it may not be historically used.
We had a question come in, guys, that asked, how does an organization know if they have a good or bad level of financial assets? What's your take on that, Janice?
Sure, there's certainly a lot of industry benchmarks out there, and I don't know that there's a good or bad level. I think it's, where does the organization want to be given their future projects, their future growth, their future initiatives. I don't think I've seen an organization that wants less than 60 days cash on hand. I certainly see more that want to be between 90 and 180, but that's not all of their financial assets that would show up in this footnote. That's usually more focused on the cash that they want to have access to. But it depends. If you're expanding and doing a major new project, you're going to want more liquid assets to fund that, as opposed to another organization that's probably rolling along and having great mission, but pretty much staying at the status quo. What have you seen, Gary?
One of the things that comes to mind is that often you have these restrictions of the cash and financial resources that you have on hand, and you've got to show those as deductions to your financial assets in a disclosure. And some organizations start to really see very clearly that they do not have a significant amount of financial assets that are not already restricted. And so that's an important part of the disclosure. It actually opens up the eyes of some of our nonprofit clients to see that, hey, we have some financial assets, cash on hand, but it is in fact restricted. So that is brought out very clearly in the required disclosures.
Yeah, I think that really gets to the reason for this disclosure in the first place. You know, a lot of readers of financial statements were quote unquote blind to that fact, Gary, that even though you have a healthy cash or investment balance, a lot of those funds are spoken for.
Really true.
And I think, I sit on some boards, but I'm also the auditor. I wouldn't want to be surprised with that at the last minute or 3 or 4 months after your year end when your audit is finalized, which is when a lot of organizations are looking at that. So it would certainly be good to be communicating that early if you are seeing that, particularly in your 630 financial statements.
I got another question in here, guys. I'm gonna read it to you kind of off the top of my head here from one of our participants. What if a restriction is designated for a certain operational program? Is that still considered restricted? So the answer to that, I'll answer.
Right.
Go ahead, Jim.
The answer to that question is yes. If the board has designated funds and set aside funds for a specific purpose, particularly I see this with capital improvements, right? If there's a capital improvement project that the board is setting aside funds for, that needs to be taken into account in this disclosure. The disclosure is around available for general operating purposes. That's the purpose of disclosing your liquidity and availability of resources. So financial assets that are available for general operations. So yes, to answer that question, it will be considered designated restricted.
And I think that's important if you're going to put it in the table, but you also have some flexibility with the verbiage in the paragraph that you're writing underneath that you could provide some explanation around how that could be utilized. But if you are using a tabular format, that would have a restriction on it.
Yeah.
All right. So as we continue to build here, we'll turn the last and potentially the most significant for most organizations topic of functional expenses over to Gary.
Thanks, Janice. So functional expenses has certainly been something of a significant time invested in this process when it comes to functional expenses. You know, for example, organizations such as business leagues, associations, those are 501c6 organizations, have had to go down this path for the first time as they have not had to do functional expense reporting in the past. So it has been one of the most significant areas, as Janice said, regarding the new standards. So it's a requirement for all nonprofit organizations to express to put their expenses by both natural and functional classification. So natural is your salary, rent, office supplies, those types of things. And then of course your functional are program, management in general, and fundraising. And breaking programs out into multiple programs, as we'll show you here shortly, is a significant part of this process. This is required, these functional expenses, to be put in one location in your financial statements. The either a statement of activities or a separate statement of functional expenses or into the notes to the financial statement, so you can actually disclose in the notes your functional expenses, putting natural classifications down the left-hand side, and then programs across the top to show the functional expenses reporting. So you have some flexibility here with how you do it, but you got to do it in one spot.
I can say the vast majority of financial statements that I'm seeing and organizations that we work with is they are choosing the separate statement right there in the middle. So you have your statement of financial position, then your statement of activities, then your statement of functional expenses. It's just very clean and it's right there on its own. And here's an example of it. I do know one organization that put it right on the face, but they're very small. They have just one program, and it was very simple to add 4 or 5 lines to the face of the statement of activities. But that's the only one I've seen in nearly 100 that we've taken a look at.
Right. That's exactly what I'm seeing as well. Even for very complicated consolidations, which have for-profit entities included in those consolidated financial statements for nonprofits, showing the activity on a statement of functional expenses. One of the things that you want to do is this gives you an opportunity to relook at what are your main programs. So, for example, in this particular slide, emergency shelter, food bank, and other services are the two programs that this organization has decided are their major programs and that they want to report on. And typically, this also leads into and facilitates reporting on the 990. On page 2 of the 990, you show your program services and accomplishments by program. And it's typically 3 or more programs on the 990. This gives you an opportunity to possibly streamline that, put it into 2 or 3 categories. Some organizations have got programs that are, 6, 7, 8 or more. It's an opportunity to take a look and see whether you might want to combine a couple of them.
Sure. I was just looking at an organization the other day, Gary, that had 3 or 4 nonprofits, and they combine them all because they're under common control. And we started going to the 990s to see which programs that they identify as their significant programs. So we have to first look at that. Then we have to look to materiality and figure out how many columns. I mean, we started with, they could have potentially 9 different columns, which is quite cumbersome.
It's way too many.
It's way too many.
Right.
So we are going to streamline that and get that down to probably the 3 or 4 most significant ones. But it's not as simple as it was before, where you would just have program management, general, and fundraising. If you did present this, you now have to disaggregate it.
And again, on the statement of functional expense, you see the natural classification down the left: professional services, office expenses, depreciation, which is allocated across through all the categories. On this particular example, depreciation, it's not just all management general for most organizations. Mm-hmm. So as part of this, you have to include a description of the methods used to allocate costs among program and support functions. You have to allocate when, the question often comes up is when to allocate management and general costs. Activities that represent direct conduct or direct supervision of a program would be allocated. So you'll see a number of examples down there. The finance function, CFO, is generally going to fall under management in general, and potentially investment expenses also will fall under management in general category. CEO, certainly in small organizations, will have some time allocated to programs as they work, roll up their sleeves and work in the programs. And of course also would have management in general fundraising allocated. These would be allocated based on things such as square footage and benefits derived by the particular program, or is it just management general or fundraising directly allocated? Depreciation interest expense is expected again to be allocated out. So you need to look at that particular process.
Sure. As the FASB wrote this standard, the committee that was working on it said that that was a very specific interest of theirs, that they believe most organizations got that wrong when they did present functional expenses in not allocating depreciation and interest expense. And they do expect to see that being allocated across the programs, management in general, and fundraising.
You kind of look at your fixed assets, and if you're utilizing fixed assets within a program activity, then they certainly deserve a portion of your depreciation expense. So a little bit of lessons learned here. Decide on a method of presentation that is most useful to the readers of when it comes to your nonprofit organization. And as previously said, the separate statement is the most common. We've definitely seen that as the most common process that we've gone through. I'm not sure I've even seen it disclosed in the notes yet.
No, I haven't seen it in the notes yet. I've seen a few smaller organizations use the statement of activities approach. Those are generally the ones that might only have one program, right? If they truly look at their program activities and it is one program, and not a lot of different types of natural classifications to disclose. I've seen that, but vast majority on a separate statement.
Yeah, I also haven't seen any organization choose to put it in a footnote. It doesn't mean you can't. It just means that's not being chosen by a lot of the organizations out there.
Again, determine the significant material programs. As Janice indicated earlier, the IRS Form 990 may be a starting point for programs, and that's where I've been pointing a number of our clients to is, hey, let's look at the disclosures that we have in the 990 for programs. And those same disclosures should go into your footnote number 1, your significant accounting policies note. You should clearly show each program that you're going to be reporting on and a brief description of what that program is. It may not be as detailed as the 990 disclosure, as you can be very generous with the amount of disclosures in your 990, but certainly the key parts of what derives your program should be described in that first note.
I'm still seeing that get missed a lot when I'm looking at financial statements of going back and saying, I determined I needed 3 columns on my functional expenses, and I got those costs allocated to the 3 major programs, but not going into footnote 1 and making sure we adequately describe each of those major programs.
Definitely one of the things that we're working with our clients on. Absolutely.
And on the opposite end, I've seen organizations take this too far and describe every program and every activity as a separate program within the financial statement note number 1. And that was never the intent of this standard. It's supposed to be those significant programs that you are operating and choosing to organize. So we said it a couple times, and Gary, I'm not trying to jump in on your slide here, but keep it simple and use materiality, not only from a natural expense standpoint, but also from a disclosure of program standpoint as well.
Absolutely. And keep it simple, use materiality. Not every natural expense needs its own line. I think that's really important. We've got some financial statements that we've seen that show, in just unbelievable detail, different lines for their expenses, travel expense, conferences,
subscriptions, $123.
Licenses and fees, again, $250, those types of things. Let's make it simple. Let's make it more streamlined. Absolutely. Okay. And you've got to document your methodology for allocation of expenses. So you've got to disclose in your notes regarding what natural classification lines are actually allocated and what is the method of allocation. Are you using square footage? Again, benefits derived, those types of things. And that's often put in a disclosure that's a tabular type format, showing, hey, here's salaries, and this is what is the method that is used to allocate those expenses.
Gary, we just had a question come in on this exact topic around the methodology for allocation of expenses and what level of detail is needed in the footnote disclosure for the allocation disclosure, as well as are you seeing organizations take on things such as doing a formal time study, and what level of documentation are you seeing when it comes to that allocation that just came in?
Good. That's a real good question. When it comes to documentation and for us, when we're going out to do an audit, we're looking for a reasonable and consistent process established for your natural classified expenses. And so, detailed time studies, we're not seeing necessarily that, but we want to see some reasonable processes in terms of how you're allocating. And I think that's it. In the nonprofit world, reasonable, consistent processes, I think, really makes the most sense.
I've seen a lot of organizations say that salaries are time and effort. So then they have the time reporting to back that up, that in a given day you could spend 2 hours on this program, an hour on another program, and then the rest of the time is like management in general. And they're able to capture that for organizations that aren't capturing that in a more sophisticated manner, they would look at the job description and say this individual or this role should be spending 50% of their time on programs, 30% on management in general, 20% on fundraising. And they would use that and from time to time go back and make sure that that makes sense with the job description. Obviously, the more detailed, the better, but you have to think about materiality and cost benefit as well.
And it's perfectly okay for that study to be done internally, correct?
Yes.
Yeah, it doesn't have to be done by an external firm and done in that manner, correct?
Correct.
Yep.
But I certainly think the larger the organization and the more significant those numbers and the allocations can be, and particularly to the users of those financial statements, the more accurate you would want to be. So
Absolutely.
management's going to have to decide that.
Again, this is probably an area that requires the most time for most nonprofit organizations, is how are we going to do our functional expense reporting?
Yeah, we have a whole nother slide of lessons learned.
So we'll see if we haven't hit these all already. Changes, reclassification of prior amounts if presenting comparative. As Janice said earlier, you could do a single year presentation, but if you do both years, you may, if you have significant reclassifications of previously presented information on expenses, you do need to disclose what those reclassifications are, if they're material. Excluding costs from the schedule of functional expenses such as cost of goods sold, special event cost. The only expense to exclude is external and direct internal investment expenses, which for a lot of organizations that may not even be applicable or material when it comes to investment expenses. But special event costs are down there in your statement of functional expense reporting, cost of goods sold. We're also seeing no allocation of depreciation interest expense still, and we're really consulting with our clients to do those allocations as well.
I think I'm seeing a lot of organizations that they may have a for-profit subsidiary that rolls up into the nonprofit and gets consolidated, and those costs aren't part of your functional expenses, and you actually would need the costs of the for-profit subsidiary broken out separately at the bottom to reconcile to the face of the financial statements. So there are some examples out there of that nature, that the functional expenses in the table are supposed to represent those of the nonprofit organization. But I'd say even more complex are organizations that have multi-entity consolidations, and maybe some of them are nonprofits, some of them are for-profits, and the underlying nonprofits have their own financial statements. And the organization is now going, oh, wow, I have to do eliminations to get back into the consolidated functional expense schedule. And it's something they hadn't thought about until they get to this year-end reporting process. And it's going to be very time-consuming of which entities, which programs, which services, and which category do the eliminations apply to get them back to the right buckets of the functional expense schedule. And I just think if you have that, do not underestimate the amount of time it's going to take you to both document that methodology and then apply that methodology, because it's not as straightforward as you may think.
Very true. Okay. So polling question number 3 here. So which major change from the accounting standard that we're talking about today will cause your organization the most time and effort to implement? Should be an easy one. This is a softball. Right over the plate to hit it out of the park.
And as you're taking time to answer this question, we'll give you guys a little bit of time. Think about those additional questions. I appreciate the ones that have been coming in throughout the webinar. We're getting a lot, which is very, very good. And some of those are actually sent to us prior to the webinar today during the registration process that we'll try to get to as well. But keep those questions coming. And if we don't get a chance to answer them today on the air, we'll do our best to get back to you. So we're going to keep this open for about 10 more seconds. I can see the participation rate has decreased a little bit, but we're still doing pretty good, guys. We're at 88% have voted.
Well, and at least a third of you just want CPE.
Yeah.
So.
And here are the results.
Mm-hmm.
Functional expenses, 72% say that would be the most time and effort to implement, and I think this panel would totally agree with that.
Absolutely.
think interesting on those results is that liquidity and availability of resources is below net asset classification. That's surprising to me, with it being a completely new requirement and new disclosures, something that's never been there before. I would have expected that one a little bit higher. Okay. So as I mentioned, there were a couple of questions that came in during the registration process that we're going to address. Again, fire those questions to us now if you have them, and I'm going to let Janice start with this first one.
Great. So the first question is, do these new standards apply to very, very small not-for-profit organizations? And does size matter as far as the standards go? Gary or Jim, would one of you like to answer that?
It does, of course, go to all nonprofit organizations, big or small, little or tall, you name it. So size does not matter as far as the standards go. Materiality, of course, as we always say, is an important part of the process regarding required disclosures or presentations. So if you're small or large, again, you've got to implement these standards.
Yes, I know. I just worked with a very, very small nonprofit. We're talking revenues of about $250,000, and they did have to implement, but they were able to do their functional expenses right on the statement of activities because it was only like 4 lines, because most of their expenses are salary and rent, and then other, and there really wasn't much else, but they still had to explain how they were allocating those salaries between their one program, management in general, and they only had 1.5 employees. So they still had to explain it. It's just a lot simpler when you have 1.5 employees and only 3 lines. So you still have to do it. You still have to do the liquidity footnote. You still have to look forward for a year. It is simpler, yes, but you cannot just disregard the standard. The next question that came in ahead of time is, what are the biggest hurdles your clients have faced with the functional expense disclosures?
Janice, I think you hit on one of them already, that multi-entity consolidation. That's a big one I've seen as one of the hurdles to get over. Another one that I've seen is when you're going back to present and present the prior year information, it really causes you to relook at some allocation methods and the way that things are being allocated. Is that causing a reclassification or change to prior year amounts? I've seen that happen a few times over the last couple months, where organizations are spending a lot of effort on representing the prior year functional expense allocation, maybe when they weren't required to do so anyway, and maybe a single year presentation would have been a better solution to that problem. Those are two of the hurdles that I immediately thought of when I saw this come in.
Yeah, I still see that when you look at the functional expenses from the previous year. If the organization chose to disclose them, were they allocating depreciation? Were they allocating interest? Like, do you know some things on the face that they just aren't able to keep presenting them that way going forward?
I think one of the things that may be the result of this is in your functional expenses, when you're looking at the percentage of your total expenses that are program, management in general, and fundraising, the allocation of things such as interest expense and depreciation to programs, for example, may be a benefit to provide a higher percentage of program services in terms of your total expenses. So that's one of the things that could be a positive of this process.
Great. So then the next question that came in during registration is, how broad detailed do the expenses lines need to be for the natural and program classification? So as you break them out on the functional expenses. So I certainly know I've worked with a lot of organizations where you start going through the general ledger and you can see the salaries, and then you can see benefits and payroll taxes. You can see their rent or other occupancy costs, utilities, professional fees is generally a line that's out there, depreciation, interest. But as you start to work down the expenses, you start to get to dollar amounts that are very, very small. And I think when you aggregate them all, you can say, does this amount make sense to have them all in one line as other or miscellaneous? Or is it just too large that we need to break it down a little bit further? And you have to look at your financial statements and see what makes sense in relation to that.
Yeah, I hate answering it depends, Janice, but it
I kind of did that, Jim.
I said it. Definitely depends. We've said it a couple times today, materiality comes into play. So you don't need to have a list of 40 or 50 different natural classification of expenses just because you have them. Look at those more broad categories: occupancy, professional fees, interest, depreciation, etc.
All right. Do we have any other questions that came in, as we have about 4 or 5 minutes left?
Yeah, we did have one question come in. And again, keep submitting those in to us. We will be here for a couple more minutes. Gary and Janice, a question came in regarding, does this apply to cash basis and modified cash basis financial statements? And what does that impact look like?
Well, when you're looking at cash basis, modified cash basis, you're looking at other methods that are not in accordance with generally accepted accounting principles. So our suggestion is always, when it comes to these presentations, is to do as much as practical regarding the disclosures that are for generally accepted accounting principles. And so, that's the big, big thing. Liquidity, disclosure, I think you should have that type of disclosure in your financial statements for a modified cash basis.
Yeah, I think, changing the terms from unrestricted, temporarily restricted, and permanently restricted to the new categories with and without donor restrictions, it just answers that question if somebody was ever to look at those financial statements, was this standard contemplated? And yes, and using outdated terms would never be our recommendation. We'll keep the questions open for just a few other minutes. If there's anything else that has come in, please go ahead or anything comes to mind, please go ahead and send that to us. I think we'll take maybe 1 or 2 more, if that works for everybody.
Sure, I think we can take one more.
How many clients are using the 2-column approach versus the pancake approach? This is something that just came in from one of our staff members.
Well, I'm a little skewed on that one because I work with a lot of healthcare entities that are required to use the pancake approach or the more linear approach. So I would say 75% of the organization I work with are using that approach. I don't believe that's true for nonprofits as a whole. As I look at other nonprofit organizations that have the choice, I'm still seeing a lot of the columns. What are you seeing, Gary?
Absolutely. If you've got temporary restricted or net assets with restrictions, going with the 2 columns is still a very popular process for a lot of our clients. So the pancake, I'm seeing a little bit less.
Okay, another question came in here. It's kind of a loaded question, I think, but appreciate the person for asking it. How much time is needed for implementation?
I don't know, are we talking a $250,000 in revenue nonprofit with no balance sheet, or are we talking?
Yeah, my answer is, how much time do you have? No. Again, I think it depends. We've gone through a lot of the different changes and what those look like. Materiality, keeping things simple comes into play. But it is a significant part of the process. It's a significant process. It can't be just kind of blown off to the side. So it's really hard to quantify.
I think you've got a multi-entity, very complex consolidation with for-profit subs, and you've got to start digging into the allocation of those functional expenses. You could easily have 40 to 60 hours just into that process.
Oh, easily, yeah.
And that's assuming you have good underlying data. So, and that you've had a methodology in the past. But that may give you a ballpark on just one of those. Like, it should be on the higher end if you have good systems and data to back that up. And if you don't, then you have a much longer process to do that.
Yeah, making a lot of changes to footnote disclosures. Gary, sorry for cutting you off,
Sure.
but often requires a lot of set of eyes to look at things. So I'm seeing, boards wanting to weigh in on how disclosures look, senior management, line management, if you will. It just takes a lot of time and effort to get some of this stuff kind of across the finish line.
Right, and as always, you just want to work with your accountants, your auditors, in terms of who's doing what regarding the implementation process, and be on the same page before year end if possible.
Be on the same page with your audit committees or your boards too, so they have sufficient time to read new things and things where there are significant changes in those financial statements.
Well, again, thank you guys for sending those questions in. I really, really appreciate it. If there are additional ones, here's our contact information. You have that. Go go ahead and send us an email if you like the presentation, things that we can do differently in the future. Would love that. And I'm going to turn it over to Melissa here for kind of a closing.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for our future webinars. You can stay connected and learn more about all of our upcoming events by visiting us at macpas.com. Thank you and have a great day.